Welcome to This Explainer. Today we're diving straight into the absolute fundamental engine of global capital, equity securities. And look, we're not just talking about, abstract numbers flashing on a screen here. We're looking at what it actually means to own a piece of a company, how that ownership creates real value, and honestly, why it's the total bedrock of financial growth globally. We've got 6 main beats to hit today. We'll start big with a global equity landscape, drill down into common versus preference shares, map out public and private markets, figure out investing across borders, weigh the risk and return dynamics, and then wrap up with how equity ties directly into company value. Let's jump right in. Okay, kicking things off with part 1, the global equity landscape. We really need to start by just grasping the sheer scale of global equities. It kind of sets the stage for why this market is literally the lifeblood of the entire financial system. So, to anchor our understanding, get a load of this staggering data point. The United States currently accounts for a whopping 51% of total global equity market capitalization. But, and here's the kicker, the US only actually contributes about 25% to global GDP. Crazy, right? That creates this really fascinating global disparity. If you look at the US compared to markets like Japan, the UK, or China, the imbalance is super clear. And why do we care? Well, analyzing a country's GDP contribution against the size of its stock market is actually a fantastic way to spot if a market is structurally over or undervalued in the long run. The takeaway here is that as emerging markets continue to develop, their market caps are likely going to catch up to their GDP contributions. And for us, that means massive, massive potential opportunities outside of our own domestic borders. Moving on to Section 2, common versus preference shares. We're zooming way in from that macro global view to look at the actual rights attached to the specific classes of shares you can own. Because when you get down to it, corporate ownership kind of forces a choice. With common shares, you get a real voice in corporate governance. You actually get to vote for the board of directors, and you hold a residual claim on the company's net assets. Preference shares, on the other hand, they act a bit more like debt. You get the safety net of fixed dividends and a higher priority claim on assets if things go south and the company faces bankruptcy. But there's always a trade-off, right? To get that extra security, you usually have to hand over your voting rights. But hey, preference shares definitely aren't a one-size-fits-all deal. Issuers can layer on all sorts of features to attract different types of investors. Take cumulative preference shares, for example. If a company misses a dividend payment, that unpaid amount doesn't just vanish. It goes into a sort of bucket. It accrues, and it literally must be paid out in full before common shareholders ever see a single dime. Or think about convertible preference shares. These are a huge favorite in the high-stakes venture capital world. They give you the safety of a preferred payout, plus this amazing option to eventually convert your shares into common equity. So if the company absolutely explodes in value, you still get to capture that massive upside. All right, Section 3, public and private markets. Knowing what these shares actually are is really only half the battle. We also need to map out the stark differences in where and exactly how they're traded. Public markets have strict regulatory disclosures and highly liquid exchanges, right? Well, private equity is pretty much the exact opposite. It is defined by illiquidity. These securities are issued via non-public offerings. Because there's no active secondary market flashing real-time price quotes, getting into or getting out of a private equity position is tough. It requires direct and usually incredibly complex negotiations between major institutional investors. Inside this private sphere, capital basically flows through 3 main pipelines. First up, venture capital, which is the fuel for high-risk, early-stage startups. Then you've got leveraged buyouts, or LBOs. That's essentially using borrowed money to swallow up and restructure mature companies. And finally, PIPEs. This is when private capital is injected directly into already public companies that just need cash fast. And the ultimate goal for all 3 of these strategies? To build massive value behind closed doors and eventually cash out or go public to finally unlock all that trapped liquidity. Moving right along to part 4, investing across borders. As global financial systems become more and more integrated, those old historical barriers to getting your hands on international equity are dropping incredibly fast. Which brings up a really critical logistical question for anyone looking to diversify. I mean, how exactly do you buy a piece of a foreign company without totally drowning in currency conversion risks, wildly unfamiliar trading rules, and completely different accounting standards? Well, you generally have 2 paths here. You could invest directly on a foreign exchange, but honestly, that leaves you tangling with foreign currencies and dealing with potentially far less transparency. The alternative? Depository receipts, or DRs. They offer a much, much simpler route. A DR basically takes the economic interest of a foreign company and allows it to trade directly right on your local exchange. So to you, it feels and trades exactly like a domestic stock. The two big players in this space are American Depository Receipts, or ADRs, which are US dollar denominated and trade on American exchanges, and Global Depository Receipts, GDRs, which trade internationally, outside the issuer's home country. Honestly, these instruments are absolute financial lifesavers. They let you totally bypass all those clunky foreign market rules while still giving you that seamless global exposure you're looking for. Okay, on to Section 5, Risk and Return Dynamics. Now we're talking about the core engine, the absolute fundamental dynamic that drives literally every single investment decision in the financial system. If you look at over a century of data, it proves one unavoidable truth. Equities historically deliver vastly superior returns compared to fixed income assets. Between 1900 and 2017, equities generated an annualized real return of 5.2%. That absolutely leaves bonds at 2.0% and bills at a measly 0.8%, completely in the dust. But as we all know, in finance, there is absolutely no such thing as a free lunch. The crucial takeaway here is that this premium return, it's your direct compensation for taking on higher risk. Unlike a bond where interest payments are legally guaranteed, a company's future cash flows are completely uncertain. So holding equity means you are actively accepting that inherent volatility and uncertainty.
And that perfectly tees up our final section, Part 6, Equity and Company Value. Let's pull this all together and see how these concepts of risk, return, and ownership rights actually build into how we measure a company's true worth.
From an internal perspective, we judge a management team's success using accounting return on equity, or ROE. This metric is great. It tells us exactly how efficiently management is churning out net income from the actual book value of the capital that you, the shareholders, provided. Think of it as the ultimate internal scorecard for profitability. Externally, though, it's the broader market that dictates the cost of equity. And this sets a hard benchmark, a minimum required rate of return that the company absolutely must clear just to keep its investors happy. Actually, it's pretty simple. If a company's return on equity can't at least match its cost of equity, it's fundamentally destroying shareholder value. And that's true no matter how much profit it appears to be making on paper. So considering everything we've covered today, from the raw data on risk and required returns to the powerful rights you get with corporate ownership, I want to leave you with this final thought. If a company's book value is really just a historical accounting of past investments, what is it that truly transforms that number into true intrinsic value in the minds of investors? Like, how much of a premium do you personally place on a company's potential to actually shape the future? Thanks so much for joining me for this explainer, and keep digging into the true anatomy of value.